You're listening to the All-Star Charts podcast with JC Peretz on TechnicalAnalysisRadio.com.
All right, everybody. Today, I am thrilled to have longtime pal Greg Harmon. He's the founder of Dragonfly Capital. Greg, thanks for being here.
Hey, thanks for having me, JC.
You know, when I originally started this podcast and I started maybe writing down some names and thinking about some people that I'd like to bring in, you know, with 10 years ago almost, you were one of the first guys. Yourself, Joe Fahmy, Josh Brown, Tadaz, and Greg Harmon was right in there. So why don't you, before we get into the market, I want to pick your brain about what you think about U.S. stocks and some of that stuff. But, you know, how did this all get started? How did you wind up starting a blog? What happened before that? Talk to the audience.
Yeah, I was just looking at this today. I think today, in fact, is my 10-year anniversary on Twitter, which is kind of silly. But you know, I spent a whole lot of time on Wall Street, trading, managing, creating products, and then got laid off in the financial crisis and kind of was looking for something to do to keep busy while I was looking around, and stumbled upon Twitter. My wife had just started on Twitter for her Pilates business. So she got me on Twitter, and I found a whole wealth of people on Twitter that were really interested in you know, charting and in stocks and in sharing their ideas. Stumbled in with a really good community there, and started expanding the people that I knew and the people that I interacted with there. I used to, you know, post, you know, 150, 200 charts every weekend as I was looking for ideas. And it was really just part of my process of getting myself ready for what I was going to do the next week. So getting into Twitter and getting into social media and all that was really just a fluke of timing that, you know, if I had stayed at an investment bank, I probably would have not heard about Twitter for another 3 years and not got to meet all the people that I have since that time started. Blogging, I think I owe the start in blogging, as a lot of people do, to Josh. You know, Josh Brown was the guy that I started reading right away, and he was at that point starting to tell people about you know, how you blog and what things are important to put in a blog and how to think about yourself and how to look at it in terms of getting your thoughts out so that you provide some clarity to yourself. Howard Lindzen as well started me on that and got me thinking about you know, really just putting my process out there for me to clarify myself. And those two, reading them for a while, started to get me to the point where I finally got down to writing a blog. It was one day, it was like May 2010, I think it was, that the markets were starting to pull back a little bit, and people were starting to get all pissy on Twitter about how technicals don't matter anymore. It's all about fundamentals, and I just got totally off the chain and started writing about why technicals do matter and why they're always going to matter. And you know, it's kind of just ballooned from there. It's been a fun ride, but it was kind of just a really simple start.
You know, Greg, a lot of people, you know, they think that they could just start a blog and, you know, overnight, they're just going to be this overnight success, right? And it's a nice story, but, you know, when you started blogging, you came from an educated position. You know, not only were you a CMT, you're a CFA, you started trading on Wall Street in the 1980s. So by the time the blog came around, you know, you weren't some newbie. You may have been new on a new social media platform, you know, but the commentary, the things you were writing down came from a serious position of experience, right? So you want to talk about where that started, what you were doing in the 80s, and how that ultimately transitioned over the next couple of decades?
Yeah, sure. Yeah, I started, it's kind of a funny story about how I even got into Wall Street, because I was a mechanical engineer in college. I had nothing to do with Wall Street. I knew nothing about markets when I came out of college. And I had a friend who was, I was on the swim team in college, and I had a friend who was the captain of the team the year before I was, who was all into financial markets, and he was working at Goldman Sachs at the time, and about to leave his job, to go to Goldman Sachs, and said, "Hey, you don't like what you're doing. You don't want to be a mechanical engineer. Why don't you come in here and interview for my job, and maybe you get into finance and like it?" I'm like, "Yeah, why not?" So started working at Chase Manhattan in 1986. Was working in a business called repurchase agreements. We were taking treasury bonds that our clients, pension funds, had, and lending them out, taking cash back, and running like an arbitrage. It was really essentially like a huge levered arbitrage, almost like a hedge fund, taking credit risk. Did that for about 6 years, and we started this. It was kind of funny. We started this in the fourth floor of the basement at Chase Plaza. You know what's below the fourth floor of the basement at Chase Plaza?
No.
Well, there's one more floor, and it's the floor where they keep all the gold bricks.
Oh my God, that's hilarious.
So we go into this room, lower Manhattan, especially in the winters. You get in for a job that starts before 7 o'clock. It's dark when you get in. You get out after 4. It's dark when you get out. We didn't see daylight like from Monday morning until Friday night. It was the weekend if it was light out.
I'm familiar.
Yeah. I did that for a bunch of years. Chase Manhattan was kind enough to put me through an MBA program. I went to NYU at night. At that point, it was like walking across the street because NYU's campus was right by the World Trade Center, and it was a great experience doing it at that time in the late 80s, early 90s, because all of Wall Street's nascent hedge fund managers were teaching classes there as adjunct professors. So awesome. I learned risk arbitrage from Richard Perry. Incredible. So at the end of getting the MBA, it was like I could stay here at Chase, or I could look for something bigger to do. I had an opportunity to go up to Boston to work at State Street. Took off for State Street in 1992. Got the opportunity to build businesses there, as well as continue expanding this repo-like business into equities and into foreign equities. Started traveling the globe, was hiring people in Hong Kong, in Japan, in Sydney, in Toronto, in London. I had like a global desk working for me, and eventually kind of burned out a little bit. I moved to London in 1997, stayed there for a couple of years, and kind of burned out. I was traveling more than half the year. So in about 2000, as the market's crashing, I'm moving back to the U.S. and starting to look at building businesses, and started building a prime brokerage business for State Street. Did that for a couple of years, and then was thinking, I really like to get back to more of the day-to-day trading. Started looking around and found an opportunity to move back to New York and work for BNP Paribas on the equity derivatives desk. So they had BNP, French bank, had this big presence in New York that was all proprietary trading, known as the kings of options and swaps at the time. This was 2005. And they were looking to start to build out a client business. So I got involved in the client business there. We were running gangbusters, essentially doing equity swaps and equity options with all the big hedge funds. You name them. Like Greenlight. We had a very great relationship with Pershing Square, talking with Oxif, everyone that was big at the time. And we're making a lot of money doing this. But then, as you know, going into 2008, businesses like swaps and derivatives that were using the bank's balance sheet all of a sudden banks didn't want to lend to anyone anymore. So we kind of ran out of opportunities and sat around just trading our own accounts for about 6 months, and you could see the writing on the wall. And eventually, in January 2009, they laid off the whole group. That's when I got out of the investment banking world. I got to see a lot of great things, had a lot of great opportunities to build things on my own. Also saw the side of Wall Street that you see when you watch movies like Wall Street, with all the assholes yelling at each other, and you never want to work for these people ever again. There's certainly plenty of those people that were out there too.
Yeah.
I wouldn't give it up. It was a great learning experience.
Just the experiences themselves, right? I mean, waking up and getting to the office down in Lower Manhattan before the sun rises, leaving afterwards, and doing that for years and years, and going to have drinks at the over at the bars behind the Goldman, right? Like the old counting houses, right?
Like Francis Tavern and stuff like that.
Yep. That experience and kind of seeing that, I wouldn't trade it for the world. I totally agree with you. Now, one thing that that's always caught my attention from you, and other people as well in your situation that have both the CFA designation and hold the CMT designation, but I consistently find you doing technical analysis rather than the other. You want to talk about why you chose that route?
Yeah. In fact, I really chose the CFA route because it was all I knew about back at the time. When I said I had just moved back to the U.S. in 2000, that's when I started studying for the CFA, because I knew I wanted to go out and manage money at some point, and I knew that if I was going to do it at a big firm, I needed to have a CFA. You know what they always say, you need a CFA to get the job, and you need a CMT to keep it. CFA is all about fundamentals, and all about modeling, and it's all about creating assumptions that really have no basis in reality. But it's so widely accepted and so widely respected now. There's got to be there's probably like 1 million CFAs now. CMT, I found through my years, especially the time at BNP Paribas, was a lot more about following what was actually happening with prices, and the disconnect between a good company and a good stock. It's, a good company is nice to have if you're going to be Warren Buffett and hold it for 40 years. A good stock is a lot more interesting if your time horizon is much shorter than that. So for me, it started getting down to being able to track the price action more closely, and having that weigh more heavily in my decisions. I still look, when I manage money for clients, I still look at the quality of the company. So I look at the quality of their earnings, and I look at the multiple that they have and all that kind of stuff. But that's not a reason for me to buy it. It's a reason for me to not buy it if it's a crappy looking company. The reason for me to buy a stock is purely the technicals now, purely that the stock price is either moving or about to move or ready to move.
And when you look at the market from a technical perspective, I have a lot of appreciation, particularly for what we do during the day, that you add another layer, right? You're adding an options layer to the technical analysis you're being done. So the analysis is one way, the execution is another. You want to talk about how that sort of came to be? Your book, Trading Options, is how essentially you incorporate those technicals and then bring in the options?
Yeah, I mean, the book is really just a full-on open kimono of my whole process. Starting with a top-down technical view, looking at the full macro aspect. Trying to determine the trend, the broad trend in the market, and then trying to find stocks that are moving with the trend that look like they can outperform over the next 2 to 4 weeks, something like that. But yeah, like you said, the experience that I have, the years of experience I have in trading options and trading other derivatives, gives me the ability to look at that and say, even a 2 or 4% move in a stock I can add leverage to that because I'm comfortable with how that works and the strategies that create that, to be able to both add leverage to a potential trade, as well as protect the portfolio and the position through using other options for risk management techniques. So I look at options a little bit differently than a lot of people do. I'm not interested in whether an option is fairly priced. I'm interested in whether an option can be used to reflect a directional preference that I see from a technical view. And if I can, then I'm also looking for a second option that might be used to fund that position and get me into it more cheaply so that I have less capital represented in a trade. And then possibly even a third or fourth option to manage the risk in the trade, to make it a much more asymmetric potential payoff, so that upside wins stand more potential than the potential loss of a stock moving against my direction.
And that's really one of my favorite common denominators between technical analysis and options, right? It's being used to create asymmetric risk reward opportunities, right? Skewed in your favor, but also to manage risk at the same time. And that double whammy is something consistent that I see across the technical analysis field, as well as in the options field for sure. So while we're on that subject, about the process, in your top-down process, let's talk about current markets. Here we are in the second week of March, and today's March the 12th. When you talk about the top-down approach, you look at a lot of indexes. I see you posting them all the time. What do you think they're suggesting at this point in terms of the U.S. indexes, S&P 500, Russell small caps?
Yeah, they're all at levels that are really causing pain for both bears and bulls, I think. When you look at from the October 3rd highs, if you look at the S&P 500 from there and how it pulled back and kind of stuck in a channel for a while through October and November before dropping down to the Christmas Eve low, we're really just back to the top of that channel. And a pure classic technician would look at that and say, we really haven't made a new high yet. We haven't gotten out of this potential downtrend yet. And I think that helps create more of the debate that you're seeing going on in the markets now, that there are so many people that are very bullish because of what we've seen over the last 2 months, 2.5 months, but also some people that are very bearish because we have not made a new high yet. And the vocalness about both, I think, is creating a unique situation in the current marketplace. So for me, I look at these right now and say, you had to be investing, you had to be in the market from at least from January 1st, if not from the day after Christmas.
Yeah, definitely the first couple of months of the year. It had to be long.
Yeah, it had to be long. And can you still be long now? Yeah, I'm still as long as I've been. But by doing it with options, my accounts are back to within 0.5% to between 0.5% and 2% from their all-time highs in October, to only having 35% invested in the market, because it's almost all options based right now. So I'm doing this by managing my risk by limiting my capital exposure to the market. So I don't have to get, I guess bottom line, that means that I don't have to get involved as much in terms of taking a stand as to whether I'm bullish or bearish or where the next move is going to be, because I've got all that protection on the downside already. I've got a huge cash position. But my options exposure is allowing me to take advantage as long as we continue to drift up, which makes it for a nice situation. I can sit on the sidelines of the debate about whether the next move is higher up to new highs, or whether the next move is back down to the December lows.
And what's wrong with the argument, Greg? What's wrong with the argument that we just trade sideways for a while and we just continue to be in a hot mess, frustrate both.
We could do that, yeah. We could end up being just in a sideways hot mess, like you say, and it becomes then a either sit on the sidelines with cash or find the right individual names that are making the moves.
And I know that you focus more on individual names than the sectors themselves, for example. But you do look at things like technology and software and stuff like that. You want to take us through the process of once you identify the direction of, let's say, the indexes, how then you move to a lower tier, some of the sectors, individual equities. What's next?
Yeah, so I've got a universe of about 1,500 stocks, and every Saturday I look at every one of them, and I'm looking at them for several different types of technicals. I'm looking at Japanese candlestick formations. I'm looking at standard price patterns like head and shoulders and cup and handles and triangle breakouts and things like that. I'm looking at indicators like momentum indicators, like I use RSI and MACD. I'm looking at volatility indicators in there. I'm also looking at things like Fibonacci retracements, where we are in that process, and some harmonic patterns that kind of represent the various ratios of Fibonacci retracements and extensions. And what I'm looking for is a set of stocks, 10 to 20, somewhere in that range, that have 3 or 4 of these different types of technical analysis pointing all in one direction, saying that this stock is set up to move. And it's really not a strong function of looking at, say, technology, and then within technology looking at the software sector. It's more a matter of looking at every one of the stocks, and they happen to be popping up all in that same sector. I check that thought process, though, by using a couple of the scanning tools. I do some scanning now through MarketSmith, and do some scanning through FinViz as well to try and pull up different indications that wouldn't show up necessarily on a chart, like high short interest. That might be fuel for a move higher. And when you start to see different sectors pop up on these scans that are also the same ones that you see when you're actually looking at the price action in the chart, it ends up being a pretty strong reinforcement tool to help select those stocks that might move in the short term.
I like that perspective of going through so many charts, right? Because you're really doing the best type of breadth analysis that you can do, right? So many people, I feel like, just want to look at an indicator, whether it's an AD or percentage of stocks above or below 200 period moving average, or 50 period, or whatever moving average du jour. For me, there's no better value than sitting there and ripping through a zillion charts and be like, oh, look at this. Every single or most of these energy stocks are bottoming out or putting in a bullish momentum divergence, or, man, all of these banks look like crap, right? The fact that you're going through all these stocks and you're seeing this common theme amongst a similar group of names, that's the best breadth analysis that you can do. Yeah,
and there was another reason that I started doing it that way as well, and that's you can get a lot out of scans, but scans are set to be precise, right? So it's, if you say something that has an RSI of 70 or higher, it's not going to give you those stocks that have an RSI of 69 that otherwise look fabulous.
Yeah, exactly.
So you miss these things on the fringe that give you the opportunity for potential trades where others are just not looking.
Yeah, and also when it comes to these scans, you're essentially building these scans in one market environment, right? But how can you possibly build a scan of stocks that you want to look for in a future market environment that you don't know what that market environment is like, right? How do you know what to look for? How do you know what to build today that's going to help you in 6 months or a year from now? I never understood that.
Yeah, it's hard. I mean, a scan should be a tool. It shouldn't be your only spot to pick out a smaller group of stocks and then go from there. You're going to miss too much if that's where you start.
Yeah, you know when I like to use it? I like to use the scans at the end, right? So do all the analysis and then being like, man, I keep seeing this theme of whatever, emerging markets underperforming, whatever. So give me a list of emerging market stocks where this particular thing is happening and let me see just a universe of that list. Something like that, right? Where
Or like energy stocks are looking really great from looking at all these charts, and emerging markets stocks are looking great from all these things. Is there some crossover between there?
Yeah, it's the final piece of the puzzle. It's at the end. Once you identify the environment and you see what sort of stocks you're looking for, then you could build a scan for those particular stocks and then let them rip out the list. I mean, that I think is fantastic. But to start there, I really just don't see it. So, all right, so let's continue with now. What sort of things are sticking out? If you were building a scan right now, which I'm sure you probably are anyway, what are you building? What are you looking for?
Yeah, well, some of the common things that I'm always going to be looking for are things like high short interest, high momentum. So those types of things are always going to be on a scan that I'm looking for. And when I ran one just earlier today, just about a half hour ago, comes up with again a lot of technology names that I had been following. So some of them are reporting this week, so it's a little bit maybe dicier in terms of starting a new position. But a lot of the software companies are continue to come up. MongoDB is one that's out there now. The Trade Desk, Zscaler. These are ones that have had big momentum, but they continue. They just continue, and it seems as though they get they report earnings. They trigger down a little bit, and then they get bought up again. They just keep going. Coupa was one of those today.
Which one?
Coupa.
Yep. How do you identify strong momentum and positive momentum? Like when you say that, what does that mean exactly?
So for me, most of it comes from looking at the chart. When I'm looking at the chart, I'm looking at price action that is either pressing up or has been showing Bollinger Bands that are tightening. So that's to me a sign of a preparation for a move. With RSI that's at least over 60 and hopefully rising, and MACD that's positive and rising. But I'm also looking for both the RSI and the MACD to not be at extreme levels. So not at peak levels that they had been in at things like all-time highs or turning points for highs. And I'll look at those on a daily chart. If it looks good there, and it seems like there's a lot of potential for it to move in terms of things like measured moves or where the last major resistance level is, I'll then pull back to a weekly chart to take a look and see if the momentum and volatility aspects still look good at that level. If it's good on both of those, then it's an easy call. It's just set up the idea, and if it triggers, hop in.
I like that you incorporate multiple time frames. I consider that part of that top-down approach. Looking at a longer-term time horizon, looking at a shorter-term time horizon for more tactical opportunities, and then, like you said, if they're both lining up, it sets up for an easy risk-reward situation. Not easy in terms of it's easy to make money. Easy, correct me if I'm wrong, easy in terms of the setup and how you're going to take advantage of it, right?
Yeah, easy in terms of the setup. You know where the trigger is then, you know what the potential is, and you just apply proper risk management techniques to it, things that you've either learned through the years or developed that work for you that limit your downside if you're wrong.
All right, Greg, you're talking to people, technical analysts and traders and investors of all kinds all over the world, and everybody wants to know what you're looking at. What's Greg Harmon seeing right now? What's really got your attention?
Yeah, what's really got my attention? Well, it changes often, that's for sure.
As it should.
Yeah. So, some of the things that I saw at the December bottom are coming back again. At the December bottom, it was definitely one of those feels where you sat there on Christmas Eve and said, I feel like I'm going to puke, but I got to go spend some money and buy some stocks right now. Mm-hmm. It's not quite at that level right now, but if you look at the names that people have tossed aside because whatever reason, they had their run in the past, and I'm talking about the FANG names, Amazon, Google, Netflix. These look like great stocks again now, all setting up to break out of now 3-month bases after that initial run. So I like those, and I'm in them, but I'm in them with options. The software stocks I talked about, I've got a bunch of those now. What else do I have here? Banking systems. So, we didn't talk about the teaching part a whole lot yet, but I've been teaching classes in fintech and starting to get more involved in banking technology, and have seen a ton of great opportunities in this space. So today I bought some Square. Today I bought some WorldPay. PayPal's another great one. So I think that those are the areas right now.
Visa making all-time highs today.
Yeah, Visa. I've got some MasterCard too.
I was talking with Howard Lindzon at Charge Summit in Breckenridge a couple of weeks ago. Him and I had like a fireside chat, and he was talking about how the Visa and the MasterCard and these payment companies are the railroads of 100-something years ago.
Yeah, they are. This is what there is to invest in. These are all companies that are revolutionizing what's going on in the technology space within finance.
Well, before I let you run, Greg, why don't you talk to me a little bit about, what you're doing on the teaching side? Ralph Acampora, since I was a lot younger, used to always tell me, at JC, always try to teach as much as you can because it always brings you back to the basics. Have you found that?
Yeah, and it also makes it so that you are forced to try and explain things in a way that that everyone can understand them, not just like expert practitioners.
Yeah.
So I started teaching 4 years ago. At that point, I was teaching a class on how to protect portfolios using options. Because we're still in a world where the academic view of finance is all about fundamentals and not about technicians. So I'm piecing my way into bringing technical analysis into the classroom. Got a whole bunch of people interested in it now, but just this past couple of semesters I've started teaching classes in investing and in how the banking system and money in banking works. So getting more involved with the undergrads at this point now. It's kind of fun talking to them about the total academic aspect of it that everyone on the fundamental side goes back to, CAPM and the security market line and using multiples and all this stuff, and then being able to say to them, all this stuff is bullshit too. All these people that are making these analysis, they're all just waiting to go talk to the company and find out what the company thinks they're going to do, and then they're creating some crap story around it to make it so that they're incented to go off and do other business with the company.
They really enjoy it, right?
Yeah, they do. They love it. They love hearing the stories.
Yeah, it's fantastic. I've been lucky to speak at different universities around the world, really, and I just find the students are my favorite people to talk to. They're just interested. They want to learn, and they know they don't know anything, so they're just super open-minded.
Yeah, and it's been a good transition the last 2-3 years as well, because they all come in with no money, so none of them know anything about trading stocks, but none of them will admit to it, but all of them will have had some experience trading cryptocurrencies. It's easy to set up a related story in talking about cryptocurrencies or something like that and bring it back to how stock prices work and how technicals are important. So it's kind of fun doing that too.
All right, so let's finish with that. What do you tell me about these cryptocurrencies? What are we doing here? Are we buying them down here or what?
It's like been in no man's land for like the last 6 months, right?
Yeah.
We leveled out from August through to the end of the year, took a nosedive again on Bitcoin, and then started leveling out again now around 4,000. Looking at the other side of it, I think that there's still a ton of opportunity for the flip side of Bitcoin, the blockchain, to revolutionize all finance and cut out a ton of middlemen, cut out a ton of cost. And it's also getting more and more clear to me that it's not going to be the way that the Bitcoin purists wanted Satoshi Nakamoto's view of the world to be interpreted. It's not going to be totally open and totally unowned by anyone, permissionless, etc. I think it's got to work the way that JP Morgan coined, trying to have companies create their own little networks. We've got to go through that step first before we can get to the point where we've got an open situation where there's no ownership of data anywhere. It's just too much at stake for people like JP Morgan and every other investment bank to just give up all those cash flows at this point.
All right, so you think just stay patient, no reason to jump in. This is still a downtrend?
Stay patient. We may be bottoming. There's a lot of good stuff going on. Things like Fidelity setting up a custody business. That's a real plus. The SEC cracking down on ICOs and token offerings and saying that they're illegal securities offerings. That's a good thing. But you need to get some institutional money in there, and institutional money needs the infrastructure before it's going to be really a viable market, I think, in terms of trading the currencies.
Yep, I think that's very well said. Makes a lot of sense to me. I certainly agree. I don't really see any reason to jump on in. Seems like lower lows, lower highs. Talk to me when Bitcoin's above 4,600 again, and maybe we'll have a different conversation. But for now, we'll just leave it at that, Greg. Known you for a long time. I really appreciate this. Thanks for doing this.
Yeah, this was fun, JC. I'll talk to you again soon, I hope.
Yep, see you soon.
Thank you for listening to the All-Star Charts podcast with JC Peretz on Technical Analysis Radio. To see all of the charts mentioned on today's show, please visit allstarcharts.com/podcast.